In the last video, we talked about the really pretty dismal statistics for the average 60-plus-year-old household in the United States. Most of those people, most of those households were not able to generate any non-housing net worth above even a couple $100,000 over the span of their lifetime. And in this video, we're going to talk about the 2 reasons why I think that is. Obviously, this is not going to be an exhaustive list. I mean, there's a lot of reasons. Someone could be disabled or run into some financial bad luck or have some health issues that cripple their finances. I mean, there's all kinds of things that can go wrong. But I think when it comes down to the 2 main problems or mistakes people make that are actually, more their fault, it comes down to 2 things. And the first thing is people are just simply bad. And I would say very bad. People are very bad at investing. There's an investment research firm called Dalbar, and this is probably one of, if not my absolute all-time favorite study. They do this every single year. So what they try to do is demonstrate what is the actual returns that most investors get. So all the time we hear referenced, the S&P 500 or the NASDAQ or the Dow or some hot performing fund or whatever it is. We hear all these numbers in the financial media, but when it boils down to it, what does the average person actually get when they invest? And this is a study over different time periods. So for example, since this was done in 2022, this measures the 2022 investment returns. The average investor in equities or stocks returned negative 21.2% in that year. Now, of course, just seeing this number alone doesn't necessarily mean they did a bad job because the overall market also went down. However, the overall market, as represented by the S&P 500, and for those of you that don't know, the S&P is simply an index that takes the top 500 companies in the United States, invests in those on a market cap weighted basis, meaning the biggest companies like Apple, Microsoft, etc., get a higher weighting. The smaller companies on this list would get a very small weighting, but it really is the best representation of how the overall U.S. stock market performed over certain periods of time. So that S&P 500 returned negative 18.1. So the average investor underperformed, did worse than the S&P 500 by 3.1%. And what if we look back 3 years? So if we look back 3 years, the average fund investor earned 4% per year. Compared to the actual stocks that they were investing in, they returned 7.7. And these are per year. So this would add up over time, and even worse, this would accumulate. It would be a compounded effect. So they underperformed by negative 3.6% per year. And you continue down the list, 5 years, 10 years, 20 years, 30 years. Over the last 30 years, the average stock investor earned 6.8%, which compared to 9.7% had they just bought an S&P 500 index and not done anything else. So this negative 2.8% per year represents the cumulative effect of investor mistakes, of additional costs, but most of this is represented by investor mistakes. People selling out of, say, a dividend or a value fund and buying into Cathie Wood's ARK at the beginning of 2021. It's seeing the triple leveraged QQQ go up so much and buy in 2001 right before it absolutely collapsed, and then selling at the bottom before it recovered. It's all these mistakes that people make, compounded on top of layers of fees, which we'll talk about that a little bit later. And even if you look at bonds, so they measure how the average fixed income, meaning bonds, this could be treasuries, corporate bonds. We'll talk more about this later on. But the average bond investor actually lost money over the last 30 years, not inflation adjusted. They actually lost money, whereas compared to the actual bond market, as represented by the Bloomberg U.S. Aggregate Bond Index, which is basically just every single bond in the United States, that returned 4.6% per year. So an underperformance in fixed income of 4.7% per year. So let's put some numbers to this. Let's say that you had invested $100,000 30 years ago, and I know this is a lot of money, but let's just say hypothetically did $100,000 30 years ago, today, the average investor would have turned that $100,000 into $719,000. If this same investor had just put all of that money into the S&P 500 and not made all these mistakes, they would have grown that portfolio to $1.6 million. So over the course of 30 years, all of these mistakes essentially added up to nearly a $1 million gap from what they actually had to what they could have had. And as big of a deal as investment mistakes make and how big of a deal they eventually are to your long-term net worth, the biggest issue is not the investment returns, it's the initial savings. Most people are bad at saving. This is a chart from the U.S. Bureau of Economic Analysis showing the personal savings rate for the United States going back to the 1960s. And really, with the exception of just a few spikes in 1975 and then here during the COVID savings, when basically the government just rained money all over everybody and we had way too much and we had inflation. Shocking. But anyways, aside from these two periods of time, which appear to be more anomalies, the U.S. savings rate has really hovered at around 5 to 10%. And keep in mind, this average savings of 5 to 10% resulted in that net worth that we saw in the earlier chart at age 60 when the average person had less than $200,000 saved outside of their home. So the point of this is that, at least in the United States, we are terrible at saving money. And if you don't save money, it doesn't matter how good of an investor you are, you're never going to be able to generate wealth. This is the single biggest factor to generating long-term wealth. So if we can solve these two factors for you, one, don't be terrible at investing, and two, don't be terrible at saving. If you can just do those two things, you are almost assuredly going to be amongst the top 20% most wealthy people in the United States and, by extension, the world. So in the next video, we're going to talk specifically about what this course is going to do, what specific points we are going to address, and helping you achieve those two things. And we'll put you clearly on the path towards financial independence. We'll talk more about that in the next video.